FTSE in the UK, the FTSE 100, which is the UK's leading stock market index, has hit a new 52-week high today. A little wobbles here as we go into the close there. The recent rally, though, has been fueled by hope that the Bank of England will cut interest rates at their next meeting. And if they do, it will be the first rate cut since March of 2020. Despite the recent rally, the valuation gap between the US and the UK remains pretty wide. So what ultimately might this mean for you? And how does the market landscape impact our next guest's investment outlook? Happy to say joining me live from London is Fidelity International Investment Director Tom Stevenson. He is here to take us through some of his thoughts and this investment thesis. Welcome, Tom. Great to see you again. How are you?
Hi, Pamela. Great. It's nice to be back.
Great to have you join us here today. And everyone who is joining us, do go ahead and send questions in if you'd like for Tom throughout the next little while. So there was a wobble there. Are we still at the all-time high? What happened there into the close? Or you're not quite into the close?
Yeah, well, we were heading towards a sixth consecutive day of new highs. And I think last time I looked about 5 minutes ago, literally just before the close, I think we were down 0.07%. So I think technically, I don't think we made a sixth day in a row, but yeah, I mean, broadly speaking, the FTSE 100 is at an all-time high now.
So let's dig into some of the reasons for this, and we're going to go around the world a little bit, but let's actually just go back into some of the British history of late, recent history, centering around where we've seen valuations, where the economy has gone, and where the story, the sort of argument for UK stocks is right now. It looks quite strong.
Yes, I think there is a strong argument for the UK at the moment. I mean, the last 7 or 8 years or so have been pretty difficult for the UK in terms of politics. It's been an unstable environment, and it's really over that 7 or 8 years that we've seen a divergence between the UK and other more popular markets like the US, for example. And we've got to the stage now where the UK is actually extremely attractively valued. If you look just on the sort of standard price to earnings ratio measure, the UK is priced at about 11, maybe 12 times expected earnings now, and that compares with 20 or so in the US. So there's a big valuation differential, and one of the reasons for that is the composition of the UK market. The UK is heavily weighted towards sort of more traditional sectors, materials, commodities, oil and gas, for example, which tend to be lower rated. And we don't have, we don't have the big, highly valued technology stocks, of course, which the US has. But there is a price for everything, and I think that many people are now beginning to see value in the UK. One of the ways in which this is showing up actually is in terms of takeovers of UK companies. We are seeing actually a shrinking of the UK stock market, and that's a reflection of the fact that many people are looking at lowly valued UK companies, seeing value, and we're seeing a lot of takeovers at big premiums to the prevailing market price.
Yeah, that's been fascinating watching some of the consolidation, as you say, from international investors and also within the UK. When we look at, you were talking about the government and just it's been a bit of a I don't know, there's been a political time, certainly. The geopolitical picture is different in the last few years. How does the UK look sort of as a bastion within that? It's obviously close to the European story of war that they're dealing with, but a little further away too.
Yeah, I think so. I think that, one of the things you can say about the UK at the moment is that it feels quite a stable political environment at the moment. I mean, we've got an election this year. Many countries have elections this year, as we know. We've got an election coming up probably in the autumn. And, the two principal parties in the UK have had their moments of extremes on both sides, actually. And where we stand at the moment is there's actually not a lot to choose between the two of them. They're gravitating towards the middle, which, of course, is where elections tend to be won and lost in the UK. So I think from an investor's point of view, they look at the political situation and they don't see anything particularly to worry them. I think they feel that it's unlikely that there will be any extreme measures taken by either side. So it kind of doesn't really matter from the investment point of view who wins the election. And I think that makes the UK stand out actually in a global context, because in many countries around the world there's a lot of uncertainty, and you look at the US, and I think you see quite a lot of political uncertainty in the run up to the November election there. The UK, by contrast, feels pretty stable.
Okay, really interesting. And let's go to the interest rate story now. So the Bank of England, we're all wondering when every country that has had to raise interest rates at a clip over the last couple of years is going to start cutting. Take us to the Bank of England's conundrum. They're all conundrums.
Yes, I mean, we were an outlier in inflation terms until very recently. I mean, our inflation peaked at just over 11%, which was pretty high, globally speaking. It took a while to come down, and then it came down quite quickly. And currently we stand at 3.2%. So, we are heading back quite quickly towards the 2% target for the Bank of England. So that would argue for a cut in interest rates. And I think the feeling is that we've probably got 2 or maybe 3 quarter-point cuts from the current level of 5.25% interest rates in the UK this year. So I think we will get some cuts this year. The conundrum that you mentioned there, I think, relates to what's going on elsewhere. So as we know, the pivot for interest rates in the United States has clearly been kicked down the track somewhat. The Fed is holding back, is more cautious about when it's going to cut rates. Obviously, the US economy is firing on all cylinders, is extremely strong, and the Fed doesn't feel in any need to move quickly. That, I think, causes a bit of a problem for the Bank of England, because we've already in the last month seen quite a reduction in the value of the pound against the dollar. And I think the Bank of England will be conscious of that, and they're not going to want to move too quickly. But there is a strong argument for cutting interest rates in the UK. The economy is fragile. It's not that strong. The housing market is not that strong. The rise in interest rates over the last 2 years has left a lot of homeowners in a difficult position when it comes to renegotiating their mortgages. So there is an argument for cutting interest rates, but you've got to balance it with the level of the currency as well.
Yeah, it's fascinating. And Canada's dealing with some of those things as well. And to the valuations themselves, you mentioned that it's a much cheaper market ultimately. For a while, there were reasons for that. Discuss sort of where you see fundamentals recovering essentially, and so that we can see areas where growth is in the picture for UK stocks.
Yes, well, I mean, for one thing, a fall in the value of the pound is actually quite good for UK companies, and that's one of the reasons why we've seen the FTSE 100 rise towards a new all-time high recently, and that's because many of the biggest UK companies are big overseas earners. They earn a lot of their profits in dollars, and so on translation back, a weak pound is actually quite helpful for the UK stock market. I think that the earnings growth in the UK is pretty good. It's not the UK economy is not as strong as the US economy. For example, we're not sort of firing on all cylinders as clearly the US is. But there is a price for everything, and as I mentioned before, the valuation of the UK stock market is sufficiently cheap that people are really beginning to see some value there.
Yeah, fantastic. Let's go around the world a little bit. You mentioned in your outlook for this month, earlier this month, that China is a really interesting place. The green shoot story is there. There are a lot of people that don't believe this story, that are worried that it represents geopolitical risk and therefore it's not worth putting money there. What is the other side of that?
Yes, I mean, it's interesting. I was actually speaking with the manager of one of our biggest Chinese funds. It's an investment trust, the China Special Situations Investment Trust. It's managed by a guy called Dale Nichols. He was over from Hong Kong in London because he's been managing that trust now for 10 years. He took over managing that trust from the legendary Fidelity manager in London, Anthony Bolton, 10 years ago. He was very positive on the outlook for China. He recognizes that there are issues, that there are the geopolitical issues, the relationship with the US is clearly an issue, the whole regulatory backdrop, the government, the government interference element is clearly still there. The property sector, clearly still a problem. But he said, from his perspective as a bottom-up stock picker, he is finding on the ground companies are really doing a lot better than maybe the outside world really understands or thinks. Profitability is growing in the consumer sector. He thinks that the consumer is actually stronger than maybe the conventional wisdom is about the Chinese consumer. It was obviously slow to come out of COVID, but he actually is very positive. And then layer on top of that the valuation argument. I've been talking about how cheap the UK stock market is. The Chinese stock market is significantly cheaper still. I mean, the Chinese stock market trades on about 8 or 9 times expected earnings. So he sees a lot of opportunity. He was more bullish, let's say, than I've seen him be in the 10 years I've known him.
So, because this is fascinating. So to push back a bit on the consumer, I mean, one of the arguments for consumers being as strong as they are in North America and other parts of it is obviously everyone received that fiscal push that happened during the pandemic. It was not the same fiscal story in terms of stimulus in China. Absolutely. And we've sort of been waiting, or I think investors have sort of been waiting to see something large land in the laps of consumers to help fix that in China. But that still hasn't happened. So just to go back to the consumer, how is that working out?
Yeah, you're right. I mean, and I think that was the expectation. That was when China finally did emerge from COVID. I think the expectation was that there would be a stronger recovery than there actually was. And I think one of the reasons that you're right, that they weren't sitting on free handouts from the government, as was clearly the case in the US. And you could argue that that's actually going to cause problems in the US. There's too much stimulus, and the economy is too hot in the US. That's clearly not the case in China. But the fundamental sort of story of of a growing middle class in China is still there. So it's not been stoked by cheap money as it has in some other markets, but the fundamental story has not gone away.
Okay, fantastic. There are some great questions rolling in. Let's go back to, this is a question about rates in the UK. Is the UK also aiming for a 2% target? This is on the inflation side of things.
Yeah, absolutely. That is the Bank of England's target, a 2% target. Now, and it's a very interesting question actually, because with inflation having come down from 11% to 3.2%, and it is continuing to fall.
Say that again, 11%. I mean,
yeah. Right. So this is you go back to I think it was November 2022. So about just over a year ago, 18 months ago, inflation was running at 11%, and actually that kind of understates the issue, because food inflation was running at 20% plus.
I know. I was there. I know.
Yeah, you were there. I remember. Yeah, it was a significant problem. Inflation was, I think people with long enough memories, could remember out of control inflation in the 1970s and early 1980s in the UK, and it felt like that. And also, when inflation was starting to come down quite quickly in places like the US and indeed in continental Europe, it was not coming down. It was persistent. It was sticky, and I think people were very concerned about it. But it did, once it came, and this is the way inflation works. Once it does start to move, it can move quite quickly. And I think the risk is that actually, if the Bank of England is too cautious about cutting interest rates, holds back for too long, then actually inflation goes through the 2% target, and then we start to have the other problem. And I think that's true not just in the UK. I think it's true in the US as well. I think central banks are so cautious about not repeating the mistakes of the 1970s, that the danger is that they hold back for too long.
That's so interesting. We never talk about that too. So it's interesting. Okay. Here, a couple quick questions, great questions. Again, going back to sort of the story of the FTSE being well exposed to commodities, to materials. So where do you see commodity pricing heading towards the end of this year? Canada also obviously very exposed to the commodity story. We're dying for your expertise here.
Yes, so I mean, oil and gas is an important component of the FTSE 100. I mean, we have two very big oil and gas companies in BP and Shell. You know, so I think there was a lot of talk quite recently of oil rising back towards $100 a barrel. I think there's a degree of flexibility within OPEC to manage that, and I think that the oil price seems to have stabilized in the high 80s, and that feels like a level that suits everyone. You know, I mean, it's clearly not in the interests of the incumbent US president to have a spike in energy prices in the next 6 months. I mean, that's a key factor within US elections. So it feels to me like the oil price is probably stabilized at about that level, but that's a level at which oil companies can make good profits. So I think, you know, that's actually I think that's a positive for the UK market. Commodity prices more generally, you know, obviously that depends on growth in the two principal markets, the two biggest economies in the world, China and the US, and you know, and that feels quite positive at the moment. So you know, I think that the UK market is in quite a sweet spot at the moment, because the key areas, commodities and oil and gas, I think are in a good position.
It's interesting. You don't hear that perspective all the time. That's great. So we talked a fair amount about equities and the differences in different areas. I want to swing back to Japan in a second, but just put bonds into the mix here for us. I mean, we know where rates are. We know that there's a large element of coupon clipping, which is great for those that would prefer to have less risk ultimately. But just tell us where this fits into the investment outlook for you.
Yeah, so I mean, I think coupon clipping is where it's at, because you know the pivot, the interest rate pivot, which really we have been talking about for as long as I can remember, which was going to be was really the underpinning of the bullish case for bonds, just keeps being kicked further and further down the track. And so you know, the idea that you could secure a high income from your bonds while you waited for this pivot, I think is still true, but it's turning into a very long wait. And you know, and I think that I think that there is an argument that the new normal for interest rates may be a little bit higher than maybe we expected. So you know, we've seen the expectations within the market change considerably over the last 4 months. I mean, if you go back to the beginning of the year, the futures markets were pricing in as many as 6 quarter-point rate cuts in the US. The Fed has been very consistent all the way through. It said that we're going to do 3. The market has gone from 6 to 2 or 1 or none at all. So the market has clearly got it wrong, and that is, you know, that's a key influence on bonds. So I was pretty bullish on the government bond market at the beginning of the year. I feel a bit less bullish about it than I do now. But as you say, you know, there is income there. You know, you get some diversification benefits from holding bonds and equities in a portfolio, and you're being paid to wait in terms of the coupon clipping. Yeah,
that's what we used to say about dividend stocks too. Let's talk a little bit about the idea of patience in equity markets. You had a recent Telegraph article that was talking just a little bit about what investors do with all the winnings, which is, sounds like a really good problem to have in a lot of ways, but winnings within the equity market, the gold story is also there. Bitcoin is another example of that. And you compared it a little bit to, what everyone went through in March 2020, which was, an absolute fallout of the market until it was saved by central banks, essentially, and fiscal policy, and then watching things rocket back up on the other side. We also had a rocketing up until basically in the last couple of days in the US markets and the North American story. There's been a couple of massive rallies since the COVID period. What do we need to know about what we do with winners?
Yeah, I mean, this was just a little exercise that I did. I went back and I looked at, what did well in those upswings, and then what did well in the downswings, and what did well overall. And I was trying to ask myself, what's the right approach after these upswings? Do you take a contrarian approach and buy the stuff that hasn't done well? Do you stick with the winners? And the conclusion which I came to from the evidence of the funds that I was looking at, which was principally we have a list of 50 funds that we rate highly. This is our select 50 list of funds. So I used that as my universe, and the conclusion I came to was that actually the funds which did well in the upswing tended to hold on to their gains better when the market corrected again, and then picked up the momentum. So instinctively, I feel like I want to be a contrarian investor. I want to buy the things which have not done so well. But the evidence that I got was that actually, sticking with the quality through the cycle was the better approach.
Yeah, it's so interesting because, investors get that of, wanting to be contrarian, and sometimes that works beautifully. But yeah, that was an interesting study, I thought. And I guess also just the discussion of bull market fundamentals, and taking us through some of the pieces that you just mentioned there, but the size of the rallies that we've seen of late, historical parallels, and also the valuation extremes. All of these we've been discussing in the last 20 minutes here. But tell us a little bit about the anatomy of a bull market, sort of the fundamentals story that I assume you're watching right now.
Yeah, absolutely. So, I mean, the question which inevitably you ask yourself after a long bull market, and I would position the start of this current bull market as being the end of the financial crisis. So March 2009 feels to me like the beginning of the bull market. Some people position the start of the bull market a bit later than that, but that feels to me like when the market bottomed out. So we're now 15 years into that bull market. So that it feels like the bull is quite long in the tooth. But I think if you look at the historical context, that I don't think that is of itself a cause for concern. We have had much longer bull markets. I mean, the 1982 to 2000 bull market was 18 years. The bull market in the aftermath of the Second World War was also of the order of 18 to 20 years. So I think in terms of the duration of the market, there is still potential for this to go on for a while. I think in terms of valuation, I think we're not necessarily at the end. I think it varies around the world. It feels to me like the US is a bit of an outlier. We haven't talked about the Magnificent Seven stocks. Maybe we can talk about that. But elsewhere in the world, it feels to me like there is quite a bit of value. The Japanese market does not feel expensive. The European, the UK, the Chinese, there is value around the world. In terms of the economic cycle, it feels like we are, we're in a reasonable place. It feels like we're sort of mid-cycle. And so, it feels to me like we're in the, to use a baseball analogy, we're in the 7th or 8th inning, but, we're not at the end just yet, I don't think.
Okay, interesting. You mentioned Japan. I wanted to talk about Japan. Japan's had some really interesting changes to a lot of pieces of its market. Obviously, the idea of the Bank of Japan changing its course, but also the pieces of sort of corporate regulatory, more investor friendly, where do you see, this is a long, slow burn, a lot of people are saying. Do you see it that way?
It is a long, slow burn. I mean, I think that, if you roll back to 2012, we saw the first evidence of this sort of change in the sort of fundamental structure of the Japanese business environment under the Abenomics changes. And I think that, we've had a reignition of some of those changes. I mean, what we've seen recently is some real genuine improvement in the way in which Japanese companies manage themselves, and in which the way in which they've been encouraged to manage themselves for the benefit of shareholders by the government and by the Tokyo Stock Exchange. And I think these are real changes. The way that companies are managing their balance sheets, the way in which they are looking to shareholder returns in terms of dividend increases, buybacks. I think that they're all real positives. So I think there's a very strong governance story in favor of Japan. And then I think there are other elements too. I mean, the long deflation, many years of deflation in Japan seems to have been put behind them. The inflation that we're seeing, the wage inflation in particular, I see as a positive. We've had the strongest spring wage bargaining round for 30 years. But it's not driving an unhealthy inflation that we've seen in other parts of the world. It feels like a positive level of inflation. So, I think there are a lot of positives about the Japanese market. And what are you paying for that? Well, you're paying, somewhere in the mid-teens. It's not as cheap as it was a year or so ago, but it's still not expensive.
Yeah, and if it has that long, slow burn quality that you suggested. So there are questions coming in. You mentioned the Magnificent Seven. We're not going to argue right now whether it's 7 or 5 or 3 or 4, but we've got earnings flying around coming out of these companies all over the place. Yeah, I mean, some people will say they're expensive, but actually they're not that expensive because they're just full of free cash flow. How do you put this into perspective, sort of a global outlook of how we should be looking at these stocks?
Yeah, I mean, I think the way I look at it is we've had moments in the past, and I like to talk about history because I think you learn a lot from looking at history. We've had these elements, these episodes in the past, the Nifty 50 in the early 70s, when you had this group of high quality companies delivering good earnings growth, strong balance sheets, strong brands against a backdrop of a difficult economy. Investors were craving the apparent stability and security that these stocks offered. Sounds very familiar, doesn't it? It sounds a bit like the world we live in today. Well, the Magnificent Seven is delivering that. The key difference, and it's an important difference, is that back then the Nifty 50 at their peak traded at about 50 times earnings. That was about 2.5 times the valuation of the rest of the market. So there was a big divergence between the Nifty 50 and the rest. There is a divergence between the valuation of the Magnificent Seven and the rest, but in historic terms, it's not that great. And the reason for that is that, yes, these company shares have gone up a lot. Until very recently, they've gone up a great deal. Last year, they doubled while the rest of the market rose by 12%. So there is a divergence, but it's been justified by earnings growth. This is not just a valuation story. It's also these are good companies, and I think that's a fundamental difference. So I'm cautious on the very narrow leadership of the market. That's never a good sign. But I think there are good reasons why it should be the case. Yeah, it's totally fascinating to watch this and to get your views on all of these. Just a sort of one sentence recap of how you see these markets. Like, you're happy with them? What would you say? Yes, I mean, as I say, I feel like the bull market is long in the tooth, but valuations are not extreme, sentiment is not extreme. I think we've got a way to go. Okay, Tom Stevenson joining us live from London. Delightful to speak with you as always. Thank you for bringing your expertise in these great articles. Always check out his articles in the Telegraph. I think it's worth a subscription. But anyway, thank you for joining us, and we'll see you soon. Thanks, Pamela.